Okay, we are live, everybody. And I suspect this is going to be an interesting one. Hopefully, it's not too polarizing, but of course, topics like this, there's bound to be some hate. So I'm just going to accept that and push through it. But thank you, everybody, for joining me here today. This is episode 41 of the Volatility Barometer. And you can see the rundown here. We're going to actually keep this really simple today. Just one segment about Bitcoin, and then we will get into the Q&A. And I'm going to do the Q&A section slightly differently this time. So let me explain it, because if it works well, I think I'll probably do this in the future again. So in the community section on the YouTube channel, you can just go to my YouTube page and there's a community tab. You'll see the post that's asking for people to submit their questions ahead of time. And so if you have some questions but you can't make the stream, you can go ahead and submit those early. And I'm going to split the time pretty evenly between the live Q&A just from the chat section and then also some of those submitted questions. So let me just mute the YouTube real quick here. And we can get right into this. So a little bit of housekeeping. Obviously, give the video a like for me. That always helps an awful lot. And yeah, let's get right into it, because this Bitcoin talk, it's going to be interesting. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so thank you everybody for joining me. Looks like we've got a few people watching. We are going to get right into this, and I'm going to be honest with you. I'm a little nervous. I'm feeling like there are some polarizing subjects in the investment world that if you try to touch on them with some type of rationality or perhaps even a dissenting opinion, there's always going to be a significant portion of people who just don't want to listen to anything you have to say. You're just the first word out of your mouth. They've already made up their mind that you're going to be on a certain side of it and they're going to be your enemy. And it's just going to be hate right from the start. But I do want to preface this Bitcoin stuff by saying and making very clear that I'm not actually telling anybody not to invest in Bitcoin. Full disclosure, I own Bitcoin. I actually own 2 Bitcoins now. I had a little average down period there in the last week with this crash. So I own a couple of Bitcoins myself, roughly 24,500 cost basis. And for me, there's one specific reason that I'll get into after we dispel all the myths for why I think investing in Bitcoin specifically, not crypto, but Bitcoin specifically, can actually still play a small part in a portfolio, right? For the risk portion of a portfolio. So I want to make very clear, I'm not telling people not to invest in Bitcoin. I'm just saying that there are a lot of things out there that people repeat that aren't actually true, and those are not good reasons to be investing in crypto. So if we can dispel those myths and afterwards you can still find good reasons, then by all means invest in Bitcoin, and you've got your good reasons, and hopefully it does very well for you. So for all the haters out there, while I am skeptical on the crypto market in general, I'm not here to discourage anybody, but let's get right into some of these. I'm just going to flash them up there, and then I have a few words to say on each one of them. So as always, when I show the things like this is mostly just for my own personal notes. So I'm just going to be using this to gather my thoughts here. All right, so at the risk of taking on a lot of hate here, let's get started with the top 5 Bitcoin myths that I believe people have to stop believing in. I don't think these are good reasons to invest in Bitcoin. Number 1, Bitcoin has returned thousands of percent in the last 10 years. So I'm sure you've heard at some point, you've heard a lot of people do this. Typically what you'll see is a list of asset classes, stocks, bonds, gold, real estate, utilities, bunch of asset classes, the rates of return, say for the last 10 years, and then at the very top of the list, you'll see Bitcoin, and it'll say some absurd number. So all of the other ones might say low single digit, mid single digit, annualized rate of return. Maybe the S&P 500 up double digits, but not that impressive either. And then you'll see Bitcoin at 200% annualized or something. And people are going to look at that and say, well, there you go. Which asset would you rather hold? The thing that I want people to understand is that when it comes to investing, all that matters is what that asset class could potentially return for you from the moment that you own it going forward, right? Of course, we know already Bitcoin is up hundreds of thousands of percent, over 1,000,000% since it launched, right? I mean, from pennies to whatever it is now, 21,000. It's seen an insane rise. But you also have to factor in that in the last 3 years, it's completely flat. So anybody who has invested in Bitcoin in the last 3 years, probably not very many people have made money on it. And that is relevant because we could make the same argument for other things. We could say that Apple stock, for example, is the greatest investment in the world. And how could you possibly not have your entire net worth invested in Apple? It's up tens of thousands of percent, right? It's obvious. Everybody knows that. Well, the problem is, we didn't own it in 1996, so it doesn't really matter that it's up 50,000% in the last 30 years. All that matters is when I'm ready to invest in it, what is its potential for me, right? We could do the same thing with the S&P 500. So how many times have you heard people out there say, financial advisors and people on YouTube who talk about finance channels, how many times have you heard them say that the S&P 500 returns 10% a year? And this is their reason for always telling you to buy index funds. Just buy and hold index funds. The S&P 500 has returned 10% a year. And then, of course, they'll show you some compound interest calculator of how much your money is going to compound if you just grow it at 10% a year. Well, the problem with that, if you look at, say, from 1997, right, the last 25 years, this isn't a cherry-picked number, it's just 25 years. The last, from 97 to 2000 was a raging bull market, so this is not a cherry-picked number. But adjusted for inflation, you can see the S&P 500 is up 3.6% in the last 25 years. If you reinvested all your dividends, it's up 5.5. So does it really matter that all of these people out there are going to be telling you, invest in the S&P because it makes 10% a year, but that was for your grandparents. That's, since 1928. We don't care about that. I wasn't even alive when the S&P was crushing it with those numbers. So all that matters, of course, is what is it going to do for me going forward? And obviously what we know about the crypto space is that not that many people were investing in it before the last 3 or 4 years. And that's when it's flat, right? All of these prices hit the same numbers 3.5 years ago. So just remember that it doesn't actually matter how much an asset class is up in the past. What you need to do is make an honest assessment of what that can do for you when you're ready to get in going forward. That's the only calculus we have to calculate here. We don't care it's up 2 million percent. I wasn't in crypto in 2012. That number doesn't affect me. What affects me is I'm in with 2 Bitcoins at 24,500. That's my number. I'm not expecting it to go up thousands of percents from here. So remember, myth number 1, don't be swayed by those charts that show the insane growth rate of Bitcoin. We could do the same thing with Tesla. It doesn't mean you should go out and buy Tesla. Myth number 2, Bitcoin solves the wire transfer problems of the banking system. This one kind of annoys me, to be honest, because it's so prevalent out there. You'll see people on Twitter and they'll say things like, I was in the bank and I sent a wire transfer and it took 2 days to complete the deal and I had to disclose information and fill out a form and sign my name and it cost $13. And Bitcoin solves all of this. You can just send money anonymously, instantaneously to anywhere in the world. It's great. Bitcoin solves the problem of the banking industry. But my question to all those people that use that line of thinking, do they honestly think that the big banks of the world, let's say Citibank as an example, do you really believe that Citibank can't afford a computer? Like, is this a technology problem that Citibank just doesn't have any computers to send wires instantaneously? They can't do that? I mean, we've had that technology since forever, since the computer was here. In 1980, I could have gone to a bank with a duffel bag with $1 million cash in it, put it on the till and said, I need to send this money to my friend in Moscow. And they could have taken it into the back room, put it through a money counter, takes a couple seconds, account, okay, this is $1 million, we'll take your $1 million, we'll deduct $1 million from our digital account, we'll use these super cool computers we have in 1980, and we'll send that wire transfer, and it'll be there in a minute. We had the technology to do that. I think people are missing the whole point of why the banking system is so slow and arduous in the first place. And while it's true that you and I, we're not using the banking system to launder money, right? That's not our purpose for doing these things. We're just trying to wire some money. It's like no big deal. Just let me wire my money. You and I, we are not trying to send funds to terrorist groups. We're not trying to, we're not involved in substance trafficking and human trafficking, and we're not trying to evade taxes when we go into the bank and do these transactions. You and I are just using the banking system to make our lives convenient. But it's a little bit naive to think that we live in a world where you're supposed to just be able to hand somebody money anonymously and say, give this to my friend in Moscow. The world doesn't work that way. Unfortunately, it's kind of like when we were in school as kids where, one silly kid is going to do something really dumb and he's going to ruin it for everybody. And then the school's going to come in and make rules that stop us from doing pretty normal things, right? I mean, can't chew gum in school because there's that one kid who takes the gum out and sticks it under the desk. So now all of a sudden none of us can chew gum. But chewing gum is a little bit different than, funding international groups that should not get anonymous, infinite funding instantaneously. So Bitcoin doesn't solve the problems of the banking system because there is no problem with the banking system. It's not a technology problem. It's a people problem. And unfortunately, we live in a world where there are actually a small percentage of people who are trying to do really bad things. That's why wire transfers take 2 days. That's why you have to fill out the forms and you need a passport and you need an account and they have to make sure that both people on both sides of the transaction are on the up and up. That's why. I think it's a little naive to think that we should actively move towards a world where anybody can anonymously send anything they want instantaneously. I think that just sit down for a couple of minutes and think about how badly that could go for society. So it's actually a feature. It's not a bug of the banking system. Bitcoin doesn't solve that. It's not a technology issue. Number 3, Bitcoin is the currency of the future. You'll often hear this said as well. I was just watching a little article or a little podcast, and they were talking about how Bitcoin is the money of the future. It's the money of the internet. Well, the problem is, those same people that are pitching that argument are also using that argument to get you to invest in Bitcoin. They're saying, you got to get in on this thing. It's going to go up in value because this is the future currency. Unfortunately, in order for a currency to actually function, stability is the most important part of that currency, right? It absolutely has to be stable. So you can't have both of these coexist at the same time. You can't have something that's a fantastic investment and it's a stable currency. One of those cancels the other one out. So as an example, I'm sitting here in Dubai right now, and if you're interested, last week I went into the reasons why I'm here, but essentially, Dubai is actually a country that seems to me to be pretty crypto friendly, and I'm probably going to be buying a property here in the maybe near future. So I was just looking around, and they all make a specific point saying that you can pay in crypto. And I thought, oh, that's great. Well, I would imagine regulations are coming, like as soon as the crypto market becomes a significant size. Right now it's relatively small, but as soon as the crypto market gains, popularity beyond what it is now, regulations are coming. But in the meantime, it actually would be convenient for me to just transfer my Canadian or US dollars into Bitcoin, use those Bitcoins to buy the home in Dubai, and it would probably make the whole process easy. But it's not hard to imagine that I'm going to have to do this extremely quickly, right? You can't even leave that transaction sitting there for a day. Bitcoin, it can fluctuate 10, 15% in a single day. It's not the norm, but it's not uncommon at all for it to fluctuate that much. So you could be in a situation where if you let this thing go for even a day or two, you could have a massive shortfall on that home. You thought you were transferring 500,000 and now you're 50 grand short on that home. And of course, the flip side is also true. You could maybe make 50,000, but the point is, it can't possibly function as a currency if it's fluctuating that much. Nobody's going to put significant amounts of their net worth in something that, if you leave it for more than a few hours, you could wind yourself down a lot of money. So, unfortunately, these are mutually exclusive. You can't have a tremendous investment with, growth potential and have it be a stable currency at the same time. This is a somewhat nonsensical argument that I don't even know why people make it. It's kind of a fundamental misunderstanding of economics with that one. But myth number 4, Bitcoin is valuable because it's scarce. It's another thing that you hear all the time. There's only going to be 21 million Bitcoins, and it's scarce, and they can never make any more. And this is one of the reasons why you should buy it, because it's so unique and scarce. Well, again, an economics problem here. Scarcity itself isn't what gives things value, right? If you look around your house right now as you're watching this live stream, I'm sure you can spot plenty of things in your house that are actually pretty scarce, but they're not valuable, because they're easily replaceable with something very similar to it. It's not scarce at all, actually. There might only be one of that specific thing, but that doesn't make it valuable. Value is irreplaceable nature of something. It's the usefulness and the utility that it provides. And then when you combine that with scarcity, then you've really got something. But just saying there's 21 million Bitcoins and that's all there's ever going to be, you've not said anything, right? I mean, in order for that to be an argument that holds any water, you'd first have to prove that Bitcoin itself is so useful that it's irreplaceable and we need it. But, again, just think about it for 10 seconds and you can poke holes in that argument. We've existed for all of human civilization without Bitcoin. It's certainly not a necessity in our world. In fact, I've made this point before, if Bitcoin blinked out of existence overnight and all of us woke up tomorrow and all crypto is at zero, Bitcoin's at zero, Ethereum's at zero, nobody would really notice. Like, nothing in the world would really happen other than a few people's net worth would take a hit. But honestly, the world would go on absolutely normal. Bitcoin is not a high utility object. It's not something that can't be replaced with anything. Like gold, for example. There's a reason gold is valuable. It's extremely important in the global financial system. A lot of the central banks in the world have significant portions of their wealth in gold, right? That's important. Gold itself has industrial uses. It's highly conductive. It doesn't tarnish. It's malleable. It's easy to work with. There's a lot of reasons why gold is valuable. And then you add scarcity and it becomes even more valuable. But there's a lot of earth metals that are way more rare than gold that are cheap. And the reason they're cheap is because they're not actually useful. Scarcity by itself means nothing, right? It's just, okay, there's not much of it, but you can replace it with 15 other earth metals. It doesn't matter. It's not going to be worth much. There's a reason rhodium is worth so much. It's because, again, it's, super shiny and reflective. It doesn't corrode. There's reasons why these things have value. Bitcoin is not rare at all. In fact, aren't there 19,000 other cryptocurrencies, and aren't there more and more every day? I mean, we might move towards a world where it would be weird if all of us didn't have our own cryptocurrency. That's how common and easy it is. So to say that it's rare, I mean, come on. There was a time when, having your own website was kind of a unique thing. And these days, just sign up for Wix or Squarespace. Everybody's got a website. There might be a day when crypto is so common that it's just silly to even talk about the scarcity. Plus, it's digital. So 21 million Bitcoins Can't you just subdivide it into any amount you want and there's plenty of Bitcoin for everyone in the world? I mean, I think, don't hold me to this, but I think there's something like 50 million people that are participating in Bitcoin. It's hardly scarce. A whole Bitcoin, there's 21 million, but that's just an arbitrary number. Who says it has to be a whole Bitcoin? What about 0.1 Bitcoin? Well, now there's a lot of those. There's 200 million of those. What about 0.0001 Bitcoins? It's all the same thing. It's just a digital number. So Bitcoin is not scarce. And even if it is scarce, like they're not printing more, technically you're printing any amount you want. You just launch a new cryptocurrency. In fact, there's many crypto experts out there, people who are considered experts, who will argue back and forth about which crypto is actually foundationally better than the other ones. And there's a lot of times they'll say that Bitcoin isn't even that good. So you could make a new crypto tomorrow that's even better than Bitcoin. The scarcity argument just completely falls through. Number 5, crypto can earn a yield much higher than other assets. Nope. No, it cannot. This is something that ruffles a lot of feathers when you point it out, but it seems to be rather obvious. And nobody pushes back when you say that gold can't produce a yield. Of course it can't produce a yield. Bitcoin doesn't have a revenue stream. Bitcoin doesn't produce any goods and services. There's no product there. Bitcoin doesn't have any method of providing a yield. There's no company. There's no board of directors giving dividends out. There's no way to get a yield. It doesn't produce a yield. It's like gold. There's no way to get a yield off of gold. Gold doesn't produce anything. It's just a rock sitting there. The value is the rock. It's not the yield that it can produce, because obviously in economics, for something to produce a yield, there has to actually be a method of doing that that's not a Ponzi scheme. So while Bitcoin doesn't technically qualify as a textbook definition, these stable coins that are paying these obscene yields, you get people saying, oh, you can make 20% guaranteed. You can make 35% guaranteed. Nope. No, you cannot. That does not exist. That is simply using future revenue streams to hopefully pay some people in the beginning. It's like those real estate scams that are out there where you invest in this development and they divide it into 3 tranches, right? And tranche 1 gets in early and they're guaranteed a 12% rate of return. Well, sure, because tranche 2 money is coming in and they can use some of that to pay tranche 1. So then tranche 1 goes out on social media and says it's a fantastic investment. And oh my God, I got so much money back, positive marketing. But by the time you get to tranche 3, there's no future money coming in and somebody's going to be left holding the bag. So that's essentially what's going on here. Is if you're telling me that cryptocurrency and all these stable coins out there are producing yields, I think you've misunderstood the economics of how that yield is actually created, why the S&P 500 pays a dividend, why treasuries pay a coupon rate, why real estate, if you rent them out, you can produce an income stream. This is not crypto or Bitcoin or stable coins. And you might be able to make some type of argument, okay, it's based on loaning and, secondary markets and whatnot. But even for that, people aren't dumb, especially people with money. So if you're talking about a yield coming from these stable coins, you better be talking about something in the range of, between Fed funds rate, S&P 500 dividends, and the coupon rate of a 10-year treasury. In that range, you better be talking, because otherwise, you have to understand that there's a person on the other end of that transaction, and you'd have to convince me that there are people out there that are willing to take on the risk at astronomically high rates, which, again, people with money aren't dummies. They're not going to do that at 30%. So again, not technically a Ponzi scheme, but if you see something paying a guaranteed yield, no. Watch what happens when the crypto market has a little bit of a dip. Then you get things like Terra, you get things like Celsius, you get the whole thing, the house of cards comes crumbling down because there's no future revenue stream to pay the previous people. So be very, very careful of people who demonstrate a lack of understanding in the economics of what actually produces a yield and what's required. I don't think crypto and Bitcoin qualifies, as does gold. Gold does not qualify either. There's no revenue there. So yeah, keep that one in mind. Lastly, this is not going to require a whole lot of explanation, but Bitcoin is a hedge against inflation. I mean, you almost can't say that with a straight face, but people still do. You're on Twitter today, people will still say it. So during this 2-year period, and certainly in the last 6 months, when inflation fears are at all, in our lifetime, all-time highs, certainly going back to the 70s and 80s, we haven't worried about inflation like this, and Bitcoin's down 70%. So you can't even say it's an inflation hedge with a straight face. That's kind of ridiculous. So for these 6 reasons, if any of these are reasons why you are investing in crypto or Bitcoin, you definitely want to rethink why you're doing that. Bitcoin, while it has returned thousands of percent since it launched, remember, all that matters is your assessment of what it can return for you from the moment you invest in it going forward. We don't care that it's up thousands of percent. It doesn't affect us. Bitcoin does not solve the wire transfer problems of the banking system because those are a feature and a benefit, not a bug. It's not a technology problem. It's a few bad apples in this world type of problem where, money laundering, substance trafficking, all these terrible things, tax evasion. The IRS is not going to allow you to just anonymously do whatever you want with your money. Come on, that's a little naive. Bitcoin is the currency of the future. No, it's not. Currency cannot coexist with speculative high-growth investments, so that's kind of silly. Myth number 4, it's not scarce at all. We could actually make a million other Bitcoins anytime we want. We could just rename Bitcoin to Bitcon, and there you go. Now you've got 21 million new ones, and you can also subdivide them, all kinds of silly reasons. Crypto can't earn a yield. Of course it can't. It doesn't produce anything, and yeah, laughable. So now, I've said a lot of negative things about crypto and Bitcoin. So why do I own it? If I think those, and I do believe all those things, by the way, everything I said I believe to be fundamentally true, and I would challenge anybody on any of those points. But there is actually one reason why I think Bitcoin might actually have a place as a small investment in a person's portfolio, and this is the reason that I actually bought it. So as we know, the world around us is changing. It's always evolving. And social media, and certainly certain influencers on social media, have become quite the juggernauts of the world. And pretty much whatever they say and do and the directions that these influencers are going, they have enormous power to get money moving in that direction. So you've got somebody like The Rock or Kim Kardashian or Mr. Beast on YouTube, all these people that just have insane followings. They actually can influence things a whole lot more than President Biden can, or a whole lot more than the Federal Reserve can. I mean, honestly, Kim Kardashian has more power these days than 99.9% of the wealthy politicians and all these people. They can move markets. So I look at Bitcoin, and I would only ever invest in Bitcoin specifically, not crypto in general. I think 99.9% of those coins that exist now are going to be gone eventually. But Bitcoin itself, I view as a reasonably direct investment on the power of social media. I think a little bit better than investing in the actual social media companies, like buying Twitter stock, for example. I think buying Bitcoin is a better social media play than buying Twitter or buying, Facebook or Instagram or whatever they are. That's why I did it personally. So for me, I'm kind of willing to just make that small investment. It's a very small percentage of my portfolio, and I'm not going to have laser eyes in my Twitter profile, but I am ready to hold this thing and ride this thing, and maybe not all the way, but currently right now, I'm always a person that if new information comes in, I'm willing to change. But right now, I think it's a pretty solid play on the power of social media and the fact that I do still see them pumping. And as long as they are out there pumping and convincing people that it's the next wave, it's like the internet of the 90s, all these things that people say that are clearly not true, but they're saying it with such power and authority behind it that I think it'll actually maybe push this thing forward. So 50% chance, I mean, that's plucked out of thin air, but 50-50, it goes to zero, but whatever. I mean, that's what a high risk, high reward investment is. So that's my reason. I own Bitcoin. There's 5 terrible reasons to own it, but that last one is actually the reason why I own it. So there's my take on Bitcoin, since so many people ask me all the time. That's kind of what I think. I think that there is an awful lot of irresponsible things being said about it. But price is price. And sometimes you got to participate even though you don't think it's terribly useful. Like I said, all of human civilization has existed before this, and we certainly don't need it. If it disappeared tomorrow, nobody would care. But it's with us now, so let's see what happens. I don't know. Okay, so let's see how many haters I have. Let's get into the questions. And like I said, there were some pre-submitted questions, so I'm going to check the time. I'm going to split it sort of evenly here, but I'm going to kind of go through here and see if anybody's yelling at me and calling me all kinds of names about what I said about crypto. Okay. Nothing there. I'm going to go back to the other ones that aren't Bitcoin. I'm just going to see if there's any terribly mean comments. This is about Bitcoin. How do BTC miners stay solvent as block reward reduces and everyone is hodling, so no significant income from transactions? BTC Med hit zero. It might, like I said, I mean, plucked out of thin air, but I say 50-50, the whole thing crashes and burns and just an epic disaster. And we all look back 5 years from now and say, you know, how did we not see the obviousness of the scam, right? Well, follow me on Twitter. I've been railing against it for a while now, but how do they do it? Well, I would imagine it's quite similar to all of the other commodity mining and you know, oil and whatnot, where that's a more long-term view, where if it stays below the basic replenish rate for very long, then it starts to affect the economic decisions. Like if the price of oil, you know, certain countries have different prices that they can actually extract at. Obviously, Saudi Arabia, you know, stick a straw in the ground, they get their oil. But other countries like Canada, for example, where I'm from, it actually costs a significant amount of money to get the oil out of the ground. So if the price of the oil drops below, say, $30 and it's in the 20s for an extended period of time, then all of a sudden you're going to see a bunch of the oil refineries and all that shut down. All the rigs are going to shut down. But then, of course, you've got reserves and you've got backup capital to kind of get you through the lean times. So I don't actually know right now, getting to your question, I don't know what the actual Bitcoin price would require in order for these massive mining operations to sustain. But I suspect that they could probably dip below that for a little while, you know, temporarily. But if it lasts too long, you're absolutely right. They would start shutting it down. They'd start selling their, you know, all their equipment, and that's what we would see. So it would sort of be like a slow-moving train wreck where you're going to see this happening. I don't know if it's happening now. I don't pay close enough attention, but yeah, that's a real thing. Obviously, it's just economics, right? If what you're trying to get out of the ground or get off a computer digitally isn't worth the effort you put in, then you're going to stop doing it. So that's what would happen. I think a distinction should be made between Bitcoin and other blockchains, which are highly centralized and where founders and early investors benefited from a pre-mine. Well, I mean, I understand what you're saying, but you could also make a case that it's the same thing about Bitcoin. Not directly, but you have to know that the early adopters of Bitcoin, there was a very small amount of wallets that were dominating a very large portion of the market. So while it's not like founder X launched a coin named after him and benefited all the money, it's not like that. But there's obviously a certain level of 50 or 100 early adopters taking nearly all the benefit. Like I said, in the last few years, it's flat. And so all of the regular people who invested later on, I mean, how many of them are underwater? Probably most. There was a guy on YouTube, not super big, who made million token and cashed out so much so quickly. So, well, you hear stories about this all the time. It's crazy. I've been crazy negative on the NFT market for the very same reason, that all the NFT market is a bunch of social media influencers seeing an opportunity for a massive money grab, right? So they are creating something, dumping it off to all the wide-eyed, impressionable followers that they have, convincing them that there's going to be some robust secondary market here, and they end up buying things that are just absolutely the silliest thing in the world. And again, those people are going to look at their money gone a few years from now and just say, I bought what? I bought a monkey digital picture? What? What did I do? Like, that's how silly it's going to be. But of course, the people who launch the NFTs or the cryptos, they get to take a pretty big bag home with them. So that's what it's all about. Channel Tech Lead. Tech Lead rings a bell, actually. I didn't think he was a crypto guy. I thought he was actually, I saw one video of his years ago, if it's the same person, talking about something to do with his wife left him, and he was talking about, stuff like that. I thought he was more like relationship stuff. I've just seen a couple of videos, but if he's a tech-savvy person and he's a YouTube influencer, put two and two together and scam people and take their money. I mean, this is the prime 2021, 2022. This is what it's all about. We're going to look, there's going to be textbooks written about this time period that we're going through right now, these 3 or 4 years. It's just going to be an unbelievable example of just in-your-face scams happening all the time. And I just hope, that's why I'm doing this. At the risk of getting a lot of haters, I just want people investing in these things for the right reasons. It's a speculative investment, it's highly risky, it's very likely you're going to lose your money, but there is a chance that it goes up, and that's exactly what risk-reward means. There is no reward without risk, and the bigger the reward, the more risk you take. But I just don't want people coming in, blindsided by these silly things, because these influencers, they're called that because that word means something. They are influential people, and they're very good at marketing. They're able to manipulate and pull the emotional strings of people. And there's a lot of people being scammed out there. So I'll take the heat, I'll take the hit here, and I'll get lots of people who think I'm a crypto hater, even though I own Bitcoin, and I'll take it because I want to get people focused on the actual game here. There might be money to be made, but not blindly. You're going to get taken. I'm with you regarding yield, but what do you think about interest? Well, like I said, if you want to get into a conversation about how crypto or stable coins or any of the entire blockchain industry could possibly produce a yield, it better be in the range, like I said, between about 1% to maybe 4% on the high side. Because otherwise, people with money aren't stupid, and there's just no way they're going to take on massive speculative risk to be the counterparty to something as silly as this. So it better be in the same range as, say, an S&P 500 dividend, something like 1.55% right now, 10-year treasury yield. If you want to talk about that, then great. Yeah, there's probably some secondary lending and interest rates and ways that you can sort of spin it. But if you're talking about 20% yields, that is absolutely financial engineering. That is exactly what brought down the financial industry in 2008. It's just mortgage-backed securities, CDOs, complex derivatives, pieced together, total scams that they just dump off on people. And basically, people later on down the line in the future tranches that are a little further away from the first tranche, they get left holding the bag. That's what's happening there. So if there's a 3% yield available, I'm not going to put up too much of a fuss. Anything 5% or more, you're going to have to explain to me what revenue stream crypto actually creates in order to pay that money out. What would happen to the economy of Ecuador if Bitcoin price goes to zero? I'm not up to speed on which countries have committed to which levels, but I do believe that Ecuador has made a pretty substantial commitment to this experiment, which I find heartbreaking, because when you look at countries like that, I mean, obviously you're talking about corruption that has robbed the people of their wealth. I mean, some of these countries, I'm not sure about Ecuador, but some of these very poor countries are actually probably with good management could be quite wealthy countries, which is always really sad to see that the people are, poor and just trying their best to get by. And they're actually resource rich. There's a wealth in the people and the production capacity of human capacity and just good workers. And it's just really sad. And then when you've got a government who, I mean, I understand that their back's against the wall sometimes and their own currencies are not functioning very well either. But to make a leap to something like crypto and think it's some type of savior, boy, you're taking on an awful lot of risk. And you're putting the country and the people, like you're getting at here, highly exposed to a very speculative asset that could blink out of existence. So when I said before that crypto goes to zero, nobody would care, maybe the people of Ecuador would care. There's a few countries out there that have definitely overcommitted to this experiment, which is sad to see. Nobody bought my NFT of cute pictures of my dog. Well, why not? They're rare, they're unique, they're scarce. I'm sure they were well made. Why not? What's the difference between your cute dog picture and something that The Rock has paid somebody to go make for him and say that he made it? What's the difference? There is no difference. So I'm sorry to hear that. I wish you did get a big bag of money off selling that. But like, I mean, it might get, these are so easy to make these days and it's so commonplace that, I mean, I might have a NFT of my cat soon. I mean, who knows where this crazy world is going, but it's all silly. None of it is necessary. That's the one thing that's always kind of funny to me is you just sit somebody down and you just point blank ask them, why do we need this? What is it solving? And you listen to them talk and they repeat all the old tropes and memes and all the top 5 myths that I went through. They'll repeat all of those. And at the end of it, you realize that this whole thing is just a problem. It's just a solution looking for a problem. That's what it is. They'll try to convince you that something's broken that isn't broken, and then this thing fixes it, but that's not broken in the first place. It's one of these things where you realize that it can do a lot, like the blockchain, for example, can do a lot of cool things, but it can't do anything that we actually need it to do that other things that exist already can't also do. So again, it's a solution looking for a problem. It's kind of putting the cart in front of the horse, however you want to say it. It's crazy. It's actually not that useful. People have started buying building plots digitally. And you have lost the pacifier. This blows my mind. We know the statistics about how many people are struggling financially. Like, this is something that is pretty prevalent and going to be in the future. Like, we're facing a retirement crisis here like no other. And we know that 50% of Americans live paycheck to paycheck. And the vast majority of people, like 80% of people, for example, are way short of retirement money, just way short. And we're worrying about buying digital plots in the metaverse. It's insane. Like I said, textbooks and university courses in the future will be teaching this, and we won't understand what we were all thinking. It'll be so stupid that you'll be in that classroom in school and you'll think that they're lying to you. There's no way that we went through a 10-year period where people just got so blinded by the obviousness of some of these things. I don't ever like to tell people what to do with their money, what to do or what not to do with their money, but you better be like really set financially, just absolutely solidified in your finances before you even consider buying an NFT or a plot of land in the metaverse. Or if I'm speaking to somebody who has $2 million in the bank and you think you need to go buy a plot of land next to Snoop Dogg in the multiverse, or not multiverse, why do I keep saying that? Oh, I just watched Doctor Strange recently. The metaverse. If you think you need that plot of land, okay, go for it. You've got $2 million. But for any normal people with a normal job and a normal amount of money, you've got way more important things to worry about than trying to get a cool plot on the cool street of Facebook's, whatever Facebook is doing. That's just creepy. I don't know why people do that with their money. Venezuela, same thing, committed, I think. And I've been to Venezuela. I thought it was a beautiful country. It was sad to be there because it was quite poor and alarmingly mismanaged. But yeah, they've overcommitted to it as well. I think the risk of using a lending service, you're risking losing all your coins because risk the lender platform goes under. It's not like it's regulated or insured. Yeah, exactly. There's obviously going to be major catches. And this is why I say that anything that gains any significant traction is going to require capital from significantly capitalized, intelligent people. And they're not going to be taking on that risk. They're just not. So the whole yield thing doesn't work. While I'm not going to outright call it a Ponzi, it's pretty darn close to it. So, you know what I'm going to do now is I'm going to jump over to the pre-submitted questions, and I'm going to run down that list, and we will see if this is an idea. So again, if you like this idea, and of course, many of you who I'm speaking to right now, it'll be on the restream, right? You're not sitting here live, but I'm going to say it anyway. If you like this idea, then remember that on the community tab of the website, I might actually start doing this. So you can submit your questions early. I'll put episode 42 for next week's live stream, different topic entirely, and you can submit your questions. So let's try to run through some of these. Okay, so I know you do not believe, hopefully everybody can see this. Screen share on. Okay, we are good to go. Okay, sometimes I do that. I know you don't believe in buy and hold investing, but most people just want to invest in a diversified portfolio without tracking the markets regularly. For someone like that who doesn't want to get into options or hedging, what is the best asset mix you'd suggest for a 30-year time horizon? So, good question. I'm not going to entirely punt on this question, but I am going to tell you to hold a bit because this is something that I would want to put a lot more thought into. So, of course, you've got things out there that are designed to be like a diversified portfolio that can weather the storm. That's why, Ray Dalio's all-weather portfolio, for example, very famous. Of course, he manages an insane amount of capital with all the various hedges or funds, but that one as well. Chris Cole's Dragon portfolio. The problem with them is that, and no offense to the people who constructed them or built them, it's actually not possible to make a buy and hold portfolio good, but they're pretty garbage. Like the performance, they're pretty terrible. I know that they sell really well if you watch them on a podcast. Like you watch a podcast with these people, Chris Cole, Christopher, if he goes by that, I don't know. But it all sounds fantastic, but then you actually see the results of it, and it's just, it's pretty bad. So unfortunately, there's just no way to turn garbage into gold. And you've got a list of asset classes, varying rates of return from, very low single digits up to, say, barely cracking double digits. Like we talked about previously, the last 25 years for the S&P 500, not really doing that great. And the S&P 500 is actually one of the best asset classes out there in the world, by the way, not just in the, it's one of the best indexes in the world and best assets, and it's really not doing a whole lot. So, honestly, what do you do when you're going to take a whole bunch of things that are underperforming and stick them all in one portfolio? You're going to get something that's underperforming. It's going to be pretty poor. So what I want to do, give me a little while to relaunch the options, and then I'll circle back to this, and I'll actually try to think about what I would do, right? Some people have asked me, what would I tell my wife to do with our money if I got hit by a bus? Hope I don't get hit by a bus. But what would I tell my wife to do with our money? Obviously, she can't invest in VTS because I am no longer of this world. So, what would I tell her? I think I should give that a lot more thought. So I'm not going to punt on this question, but I'm going to make a whole YouTube video in a few months, and I'm going to tell you what I think a acceptable buy and hold portfolio might look like. What are the factors? What factors go into selecting days to expiration for the vol trend strategy? So I'll just use an example of the current one that we have open right now. We have this broken wing butterfly on the UVXY. Let me make that look a little nicer. And we opened it when the price was about here, and it's drifting down. So I consider this sort of a quasi-short volatility strategy. Even though there's no risk to the upside at all, I still do want the UVXY to do its thing and naturally decay downwards so I can get the price in this range. So the price is right here. This thing expires in, next Friday, so 7 days from now. If it's, anywhere in this range 7 days from now, I'm going to get a nice profit. If it's all the way down here, obviously it's going to lose money. But I have a full portfolio of other things that are going to do well if that's the case. So I'm not really concerned about that. But why would I select 8 days? Because I opened this yesterday. The truth is, while all of my option trading is structured and systematic, and there's rules in place, it is also discretionary at the same time. There is a factor of discretion involved with strike selection, with expirations and capital allocation. I stay within a general framework, but then you can sort of deviate a little bit from it. And when I opened that trade yesterday, I was looking at the 15-day expiration and then the 8-day expiration, and the 8-day was just better for me because remember, I have a secondary allocation in that strategy. We put 50% of the money in, and there's another one coming. Just based on the way the market's moving around, I felt like doing the 8-day with the first allocation, if the market continues upwards, UVXY continues downwards, then I'm going to be able to allocate that second one before, say, the market reverses again. Because I suspect, while it's true the market has done well the last couple of days, I'm a little bit skeptical that people should be overly excited that this thing is just going to rip to all-time highs or something. I think it's going to be, if it does eventually get to the all-time high again, I think it's 19% away, so it has to go up another, 24% from here. I don't think it's going to happen in a straight line. So I want to get that second allocation off, and I just thought that it was better if I get the first one on a shorter time frame, and then next week I'll open the secondary allocation. But again, it's, I'd say, 75% systematic, 25% discretionary. Options are always going to have some discretion involved. Okay, here's a long one. I'm new to your service, free trial, planning the annual. Thank you for the support. Enjoying the content and countless. So I haven't read any of these, so I can't skip ahead or anything. The countless information on your approach to the markets. Thank you for the kind words. To get an overview of how each strategy has individually performed in the past, maybe in addition to broken down to each underlying, including monthly stats, I know where you're going with this. Is there a place where useful metrics and charts, as you show for the total portfolios, can be found? Trying to get a feel for each strategy and how the underlines act in certain market conditions. Thanks in advance. Okay, so essentially what you're saying is that the portfolio itself has all the performance statistics, as it should, right? I'm a believer that people should show performance. I think it blows my mind that 99% of the investment world can manage capital and never show any performance ever. Like, you just can't. The only way you're able to actually tell if that financial advisor or that asset manager actually knows what they're doing is if you put your money at risk and find out the hard way. That's the only way you can ever find out. It's an absolutely absurd system, to be honest. I think that in order to be an asset manager, you should be forced to manage a model portfolio and show people, at least to some degree. Obviously, individual accounts will vary, but you should have to prove something, right? I'm a former professional golfer. You post your scorecards. Otherwise, I'm going to get sponsorship money for me just saying I'm good at this? No, that's completely silly. So, of course, I always post my performance. I have been doing that for well over 10 years now. And I post the good, the bad, and the ugly. I have bad periods too. I always post it. Don't want to sometimes, but I put it up there. But I don't have the individual strategy performance, and there's a reason for that. So I used to. For the first 10 years of VTS, I used to put not only the portfolio, there was a significant amount of performance metrics up there, and I had all the individual strategies as well. But I don't do that now. It's just a little experiment. Don't think that this is written in stone or anything, but I don't actually think it's beneficial to get people focusing on short-term results. I think I got a lot of emails, just overwhelmed with emails when I did it the old system, where people get very caught up on what's happening in weeks or a month or two, and that's obviously very counterproductive to the long-term investing process. There was a question before this about buy and hold portfolios. Well, the reason people can hold a buy and hold portfolio that's getting garbage performance, but they still hold it, is Because they're not looking at it, right? They're not focused on the short term. They are told over and over constantly by the asset manager that this is a long-term process and just keep the money there and stick with the process and do it. But if you want to get a good rate of return, you have to actively manage your money. You can't beat the index unless you do something different than the index. But the problem with that is we are emotional creatures, and psychology matters a lot in investing. So the more that you manage your capital day to day, the more you're going to be focusing on the little minutia and the gains and losses, and you're going to see every single trade that went badly. Oh, I bought utilities today and it went down the very next day, and then you got me in gold and that one lost money for 2 days. And you're going to notice every single little trade. And that's not a good thing, because what ends up happening is, as we know, every investment will go through ups and downs. And when you're in a down, if you're getting people focused on the tiny little week to week, month to month, they're going to leave. They're going to abandon the system when it's down because they're watching it every single day and they're focusing on the numbers every single day. What ends up happening? Well, you get something that you're following as long as it's up. As soon as it's down, you leave. You go look at something else out there. Oh, that one's doing really well. I can see the numbers on the website. That one's doing really well. I'll move over there. And then that one starts to go down. You leave. Then you go find something else that's momentum. It looks good. I'll leave this bad one that's down money and I'll go chase that good one that's up money. And then you go to that one. What ends up happening? Years go by, you're buying high, selling low, you're entering on momentum, you're leaving on drawdowns, and you're not making any progress at all. So for me as an asset manager, I think it's extremely important to post performance, which I always have. But I also have to balance that fine line between trying not to get people to focus too much on the day-to-day, because we're going to see every single trade. The way my business works is people have to execute these trades in their own account, and that's a problem, right? If I was an asset manager, less people would leave during a drawdown because they're not actually looking every single day. It's a big problem when you're doing it yourself and watching. So a little experiment that I'm doing in 2022 is I'm showing, of course, detailed performance for the portfolio itself, but not the individual trades. I had somebody last week ask a similar question where, why don't I post all the daily emails on the website as well? Maybe time delayed, but why don't I post all those? Same reason. I don't want to get everybody focused on every little move. Of course, when things are going well, which to be honest is most of the time, then it's great. But same thing there. When it goes badly, you don't want to draw too much attention to that because you want to focus on the portfolio itself. Individual strategies are just individual contributions. So if you ever want to know any detail, of course, email me directly and ask me a specific question, and I could probably send you something. Okay. I'm following your channel for a while now. I don't trade like you, but I appreciate your input and experience. Thank you. How does inflation influence your investments? It doesn't really. Inflation is a long-term thing, like medium to long-term, whereas my investing is based on metrics that get me in and out of trades on a day-to-day basis. So factoring inflation in anything I do is completely unimportant. But, of course, inflation itself is extremely important for the big picture. Like, obviously, we don't want our money and our value to be eroding this quickly. So it's a very important thing in a macroeconomic sense. But on the micro, on the day-to-day, inflation is not important for what I do. Don't even factor it in. In your last stream, you mentioned 2022 has been a terrible year for most strategies. I generally agree, with the exception of rates traders, who have been waiting for inflation and rates volatility to pick up for the last decade. Rates traders have had a blast this year. Do you trade rates? Not just long, but short and volatility. If not, why? Well, you kind of answered it in your question here, where you said they've been waiting for the past decade. And this is unfortunately the reality of the investment world as it's set up, that virtually nobody shows performance. What ends up happening is people have these ideas or these strategies or these mandates for their funds, and they get garbage performance most of the time. And then when they get a period where it really fits in with what they're doing, They have no choice but to get out there on social media and just draw as many eyeballs as they can. Like, look at how awesome I am. It's the same thing as all the long volatility guys on Twitter, the big names, the famous volatility guys. If you saw the performance of their funds for the last decade, you would not think they're terribly awesome. But what ends up happening is you're waiting for something to happen and you're bleeding capital for months and years and years. And then when the thing finally happens, you get out there and you high-five yourself for a few months. But the big picture is pretty grim. So it kind of comes with the territory that you will see these people fluctuate between you'll see, it's coming in the future, it's coming, I promise you, the big day. And then when it comes, then they hit it really hard and they say, I told you so. And they retweet everything from the past and they bring up old statements that they made. They kind of have to. They have to play that game because the actual performance long term is terrible with just little bursts of performance. So to answer your question, no, I don't. But you kind of said it right here, basically why. It's because playing that game is not the rate of return that I'm trying to get. This is largely over multiple years a losing strategy trying to play in that market with that asset class. There isn't much to work with there. So they get a short-term fluctuation where they're hitting a home run. Of course they're going to be out there cheering, but it'll be short-lived. Another one from me. Oh, okay, some of these are long. Sorry, I didn't go through these. I wanted it to be sort of live. Another one from me. Now, based on the article 627, do you think buying straddles would be a good strategy for low vol since options are cheaper? I guess it would not be a high probability strategy, but the eventual wins maybe can compensate that. Content is amazing. Keep up the great. I'll try not to read all the compliments. Sorry, not a subscriber yet. My portfolio is small and my monthly income, for now, I can't afford. So that's fine. I mean, obviously, we all start at the same place. You can follow the articles and videos, and you know where to find me when you're ready. Obviously, I'll be here for decades. So yeah, don't worry about that. Just save, work hard, be a minimalist, all those things that I always talk about. Okay, but yes, you're absolutely right. So essentially, there are some, I actually kind of like tastytrade for a lot of the things that they do. I think that people can learn a lot of the basics over there. But one of the sort of disservices that tastytrade has sort of ingrained in people's heads, and a lot of other option traders do this, is the idea that you should just always sell vol. You just sell vol. Oh, there's something to do. There's a trade to take. Sell the vol. Short vol. Short vol. That is not a good way to look at the market. That's missing out on half the market. The reason we sell vol isn't because selling vol is always the right idea. It's because you sell things that are expensive and you buy things that are cheap. And if you do that over multiple occurrences over long periods of time, you end up with a better portfolio. So you're absolutely right. When volatility is low, that's a time to be on the long volatility side. And there's plenty of option strategies that can benefit from that. Long straddles, like you mentioned. Long put calendars do better in low vol than high vol. So if it's a high vol environment, go ahead and sell the Iron Condor. If it's a low volatility environment, you should probably buy that calendar. Things like that. So you're absolutely right that there are times to buy it. The whole volatility risk premium is sort of a function of human nature itself. The idea that implied volatility is usually, but not always, higher than realized volatility. This is simply because we're humans, and of course we overprice future unknown events because they're unknown, and we don't know how bad things are going to get, so we sort of require a premium there to take on the risk now. That's what's happening. But there are times, let's say, 25% of the time, when volatility will actually be underpriced. And that's when you should be willing and looking for long volatility positions. So when I'm trading earnings, for example, I do long straddles, hopefully during lower volatility. When I'm not comfortable with Iron Condors because volatility is a little too low, I'd be much more willing to throw on a calendar. So yeah, good question. Don't fall for that. You always have to be on the short side of vol. Sell things that are expensive, buy things that are cheap, rinse, repeat, and you'll be fine. The volatility is higher since 2018 as we're probably at the end of an economic cycle. Do you expect volatility regime to normalize? Higher during the crash, recession, and go down after it? in a few years when the market will go up again. Yeah, of course. I have no reason to doubt that basic, long-standing pattern that we see, where, of course, during the crash, you would expect higher vol. And then when things settle down and the market bounces and you go into another bull phase, of course, I would expect volatility to decline in that case. Now, one thing I would point out, though, that is on a relative basis. So you really want to be careful using absolute numbers. Like the VIX futures average, say, over a 3-year period. It might not actually go back to the same levels that it was at in 2016, 2017. That might not happen. But relatively speaking, yes, you're going to see high vol to low vol to high vol. And right now we are just in a very uncertain period where the future is as unknown as it's been since the vast majority of investors started investing, right? Most people didn't invest until post GFC. So yes, that pattern will definitely continue. But as far as the absolute levels that volatility gets to, that's up in the air. That's why I like to use things like percentiles and relative values and comparing the medium-term momentum of different metrics rather than just looking at VIX futures are averaging 14 or the VIX index is 19. That number means nothing. You need to make it relative to something else. But yeah, the pattern will definitely continue. At some point, we will go back into a low volatility regime. There's no doubt about that. The estimated commissions on Voltren broken wing butterflies can be very wide at IB seeing 182 to 550 per. Is that right? Per? I use IB. I don't know if I have special treatment, but it's not that high. But yeah, I mean, you pay commissions. Is there a minimum contract size needed to make it worth paying commissions? What factors affect the commission you end up actually paying? So good question. Commissions have changed a lot in the last few years, where your question would have been far more relevant, say, 3 to 5 years ago, when you used to pay an upfront fee that was pretty steep, like Thinkorswim, for example. The reason in 2011 I moved away from Thinkorswim and I went over to Interactive Brokers was because it was $9.99 per trade. And then you also had to pay for the option commissions, right? 75 cents per option contract. That's insane. And of course, that initial hit of $10 to open the trade is very prohibitive if you're only trading one contract size and you have an account of $2,000. If that was a 5% allocation, you're talking about a $50 trade and you're paying $10 just to open it and then $10 to close it. There's no reason to open that trade anymore. You'd have to have a slam dunk rate of return just to break even. But these days, the way commissions are structured, that upfront fee is really tiny. And in many cases, it's free. There's a lot of brokers that don't charge for that trade fee anymore. You just pay for the contracts. So in that case, it no longer matters. You can trade 1, you can trade 10, you can trade 1,000. Whatever it is, you're paying per contract. So what I would say is if you are trading with a broker, and you said IB, so they don't do that, but if you're trading with a broker that actually does charge you a significant per trade fee, you need to get away from that because it would be restrictive if you're trading a few contracts. You just wouldn't be able to do it. Things like iron condors, broken wing butterflies, there's a lot of contracts on the line. But when you're paying per contract, it doesn't matter because the spread itself is more efficient than the individual leg trades. So as long as you're not getting hit with that upfront charge, you're going to be fine. It's worth opening one contract. Like this trade, if there was one, it's still worth opening one because you're only paying for the legs. And this spread is better than anything else you could set up in a simplified single leg trade. So it's worth it. But don't pay upfront commissions anymore, or at least keep them very, very small. How many of these are there? 5 more. I'll try to go a bit faster here. You often compare your portfolio to a buy and hold portfolio of 60/40 stocks bonds. Have you ever done a comparison to a portfolio that buys into major index such as SPY or Dow on a regular monthly basis? Portfolio where 1,000 is being deposited. That's interesting. No, I haven't run the numbers. So what are the results, better or worse than a 60/40? Better, probably better. What you would probably want to do, this is another thing that I could make a future video on because it improves things a little bit. But the difference isn't quite as much as you'd think. It's probably a couple percent. But you could probably just Google it. I bet you there's people who have done really detailed work on this, and they would give you a better answer than me. So I'll eventually get around to making, in fact, I'm going to go ahead and add this one, to my video queue. I'm going to get back to that one. Could you do a mock-up of the Iron Condor wide wing from the old VTS options? I mean, I could, but this is going to be one of those very rare times where I actually say, you know, just business-wise, I can't really tell you my strategy because, yeah, that kind of goes counter to the fact that it's a business. I mean, I know the name. Yeah, just, I mean, Iron Condors, right? What's this one here? This is one that I'm just planning to do. So essentially the reason why I do wide wing Iron Condors, where the premium, I probably would widen the wings even further than this, but where the premium is actually pretty low compared to the strike gap is just because they move slower. So if you were to do an Iron Condor where the premium is actually very attractive, let's say you did a 390, 395, and then you did a 365, 360. If you did this Iron Condor, you can see you're bringing, your potential profit is much more than your potential loss. But the problem is, if you get a quick market move, the Greeks in this case, you know, your deltas and your gamma, they're going to be highly sensitive to that move, and you can actually get taken well past your stop loss quite quickly. But when you widen the wings out, it's true that your potential premium is lower, but risk management is actually a lot easier in that case because the delta and the gamma moves a lot slower, and it takes a massive move in order to really blow past your stop losses. So that's why I do the wide wings like that. And then longer dated contracts is sort of the same concept, that the longer the dated contract, again, you're basically just introducing another level of risk management, where if you're selling Iron Condors for weekly contracts or even months out, you're subject to taking outsized losses when the market does something crazy. But if you sell them, you know, 50, 60 days in advance, it's a much slower moving machine and, you know, just better overall. Obviously, everything in my business revolves around risk management, and reducing potential losses is actually the best way to make a better rate of return. So people look at it the wrong way. They think, oh, well, I could make far more money if I just take a super aggressive trade. That's true, but you'll also lose a lot more, and in the end, losses are more costly than the gains. So I tend to go wide wing, longer dated contracts. I just read Article 633 about shorting vol. In order to avoid overnight gaps in the SVXY, have you ever considered only being short while the market is open? Buy SVXY on market opening and sell before the close, basically day trading SVXY. Thoughts? So no, you can't really do this because I'm sure you've seen, but if you haven't, you can go ahead and Google, but just Google the difference in performance between the S&P 500 in the overnight session versus the daytime session. What you'll find, and I haven't looked in, you know, quite a while, to be honest, I don't really care about things like that, but what you'll find is that the overnight action is more than 100% of the gain of the S&P. I think the daytime is either flat or it could even be negative. That's just a function of the markets. The movement happens overnight. So if you're going to be a trader, you just have to accept the overnight risk in both directions. Because if you want to make those gains, you have to be holding something overnight. I understand the point of the question is when you're trading short volatility, it would be nice if you weren't subject to those big, large overnight gaps that sometimes happen that really crush us. But the flip side is also true, that you're not getting any of the overnight benefit either. So you're essentially day trading something that has a 0% rate of return. This is another one that maybe I could do a little video on that. Not the SPY, that's been done to death, but a short vol performance of SVXY daytime versus overnight. I would bet that the overnight absolutely destroys the daytime, but I'll get you that data. Good question. Can you describe how market makers work in the world of volatility options? Do we know who they are? I can't really. I've never been a market maker. I mean, I understand how they function and what they do, but you'll get a better answer if you just Google, or I'm sure if you found some articles or a podcast of somebody who actually was a market maker, they could give you a far better answer than I can. So I don't often punt, but no, I can't really explain it any better than anyone else can. Didn't they kill everything Bitcoin had going last October when the futures came out? In theory, derivatives are threatened by underlying asset price, but in real world, derivatives are a threat to the asset via manipulation. Opinion. I don't know. I don't know if it's just, I mean, it's true that it sort of coincidentally coincides with when these Bitcoin ETFs are trying to gain some exposure, and there's many in the pipeline that they're planning on launching, having a little bit of trouble getting some of them launched. Or it just could be that the market's down the last 8 months and crypto is not an inflation hedge. It's not a hedge against bad asset classes. It's not a risk-off asset. It's an entirely leveraged speculative risk-on asset. And it makes perfect sense that if the NASDAQ is down that much, crypto is going to be down way more. It's very highly correlated to asset markets. I mean, I should have actually added that to the myths, that you do hear a lot of people out there say that crypto is a hedge against the stock market collapsing. Well, boy, I don't agree with that at all. It's absolutely correlated to the NASDAQ, and worse. You know, its beta is definitely higher than the NASDAQ. So, yeah, I don't know if that's just a coincidence or if you're onto something there, but I think once we have liquid ways of actually representing a short position, that's when you're going to truly realize the value of this crypto market and Bitcoin and things like that. If they make it very difficult to short something, then it's one-way traffic, right? It's not a true representation of a market. Markets have to have two directions. So hopefully we get that soon. Okay, so I'm just going to go back in the chat for a few minutes and then we'll call this one. I actually didn't get any hate at all. I'm surprised, unless I'm not seeing them in my chat. Sometimes my comments don't show all of the comments. It just shows some of them. It's not like an actual business with products and services and cash flows to go from. Yeah, crypto, Bitcoin. Feels entirely like greater fool theory to me. It is. It's exactly what it is. I actually said that several times on Twitter, something pretty much exactly like that. And when you say that, people think you're calling them a fool. They think you're insulting them. But just to reiterate, the greater fool theory is not an insult. We're not calling anybody a fool. It's just an economic term that basically means that the value of something is based on finding somebody in the future who pays more for it than you did, right? There's a lot of things out there that could technically qualify as greater fool investments. Gold is a greater fool investment. Doesn't mean people who hold gold are fools. It just means that it doesn't have a revenue stream. It doesn't have earnings. There's no, chairman of the board that feels generous and is going to give a special dividend. There's no way to make money on gold other than the gold itself going up in value. So it's a greater fool investment that you're going to have to find a future person who values it more than you paid. So greater fool. Yeah, crypto is exactly that. Bitcoin is a greater fool investment. I'm not calling myself a fool because I do own Bitcoin, but it is. Yeah, I'm going to have to find somebody who values it more than $24,500 in my case. Fingers crossed. Do you think USD and actually US Treasuries will be the world's dominant reserve asset 25 years from now? Yeah, absolutely. I want to make clear, I'm no fan of the financial industry. I'm no friend of the banking system. I think it's annoying and arduous and scammy and manipulative just as much as everybody else. But if you want to succeed in the world of investing, you have got to trade the markets that you have, not the markets that you think you should have. And there's a lot of people out there that for some reason, they have this idea that the empire is going to collapse, just like the Roman Empire, and the US dollar is going to just crumble and it's going to be worthless, and US treasuries, nobody's going to want them anymore. And yet every single time we see a market crash, I went into this last week in quite a bit of detail. Watch last week's live stream, where the US dollar performs well every single market crash, including this one, including all the 7 previous ones going back to 2000. And I could have gone back to 1900 if I wanted to. Treasuries, US dollar, that's what the world wants when things get a little dicey. That's when you know who has the strength. And I have no reason to believe that the U.S. won't hold a very dominant position well into my investing time horizon. China will obviously have an economy itself that is larger. It might have significant competition as far as trade deals and influence around the world. But until we actually start seeing these things break down, and we are going to see it before it happens. It's not like it's going to happen overnight. First of all, you're going to have to see Italy collapse, and France, and England, and Germany, and Australia, and Canada, and all of the weaker places, and then maybe you could make a case that the U.S. is next. But the idea that the U.S. is going to be the first domino that falls, I just think that that's a wild misunderstanding of the facts that we have in front of us, that actually the U.S. dollar and treasuries do quite well during uncertain periods. So, what is this? I'm sure this is old. MJJ's statement is still shared on the screen. Who's MJJ? I don't know who MJJ is, sorry. Oh, the NFT dog picture? Mega Junior Jones, MJJ? Okay, I don't know. Sorry, did I do something wrong? Did I leave that comment on there for 20 minutes? I could have done that. I do a lot of stupid stuff on live streams. Okay, so I got that one. Can you answer first question, please? First question in the stream, I'm going to assume. Let's go to the very top. The first one that I see is this one. Did you hear about the new Bloomberg ETF is now open? Crypt. Bitcoin. No, I didn't. But I'm interested in future ETFs launching because, like I said, in order to have an actual market, you need ways to play it both sides. And then we're going to really see what this thing is. So what is Crypt? The fund is an actively managed exchange-traded ETF that seeks to achieve its objective by investing in U.S. ETFs that invest in exchange-traded Bitcoin futures. So is it like an ETF that's based on investing in the futures? So it wouldn't be the same as BITO, futures contracts and government securities. See, the problem with a lot of these is it's going to be the same problem as you experience in the volatility space. Everybody always complains that you can't just have a direct VIX ETF. Why can't we just have a spot VIX ETF, right? Well, you can't. I mean, I don't want to get into it, but you just can't. So you end up with things that track the VIX futures, and that's inefficient, of course. It's, you know, the majority of the time it's in contango, and you're going to get decay factor on those ETFs. And then if you do the inverse ETFs, you think you've solved it, but you haven't because there's beta slippage, and there's all kinds of very indirect things going on because you can't actually just have something that's the spot value. I would imagine the Bitcoin market is going to be of similar fate, that I'd be surprised if just a straight up Bitcoin ETF was even possible, let alone actually launch. I just buy Bitcoin, I suppose, but you know, I don't know. So all of these things that are based on the futures, I'll have to dig into them. Thanks for the recommendation. I know there's a few others, like the BITO, of course, that's a futures product. That doesn't look terrible, but it's not that exciting to me. Yeah, I'll look into that. Crypt. Interesting. Do you think after the end of the month JP Morgan hedge expiration, the volatility will be allowed to spike? I'm not one that puts too much stock in these types of things because you can never know the actual exposure of some of these positions that are publicized. You know, the famous one is the 50-cent trader, where every time 50-cent trader buys a bunch of VIX calls, everybody thinks, oh, that means that the market's going to crash. That means that the smart money thinks that the market's going to crash because they're buying a bunch of VIX calls. Well, maybe, but it could also just as easily be a hedge against a massively net long portfolio, right? It could also be that, but you don't actually equate the two. You just see the option contracts. So whatever this volatility hedge expiring at the end of the month is, for all we know, that's exactly the opposite of what is being advertised, right? You should never dive into the level 2 or the quotes and see these big blocks of options going through, because unless you're sitting there in the room with the trader doing it, you're never going to know what their directional exposure is anyway. It could just be a small facet of a very large trade, and you could be massively misinterpreting what's going on. So I just don't care about things like this. Maybe it's interesting, but it wouldn't affect any of my day-to-day decisions. No, I don't know what their bias is. And why would I make the assumption that I even want to track anything they're doing? I mean, 80 to 90% of asset managers out there, you don't want their performance. So I don't want to pay too much attention to what those people are doing. All right, last one. It's been too long. What do you think of the MOVE index, and do you use it or any other volatility metrics? I don't. The MOVE index is basically, a VIX of the bond market sort of thing. No, I just stick to S&P 500, VIX options, VIX futures, things like that. Sometimes I'll go as far as to go into the NASDAQ data, and occasionally when I'm trading gold or oil, especially in options trading, I might go to the gold VIX or the oil VIX, stuff like that. But bonds are, for me personally, kind of an afterthought in all of my investing. Bonds are just a parking spot for capital when I don't want to be in other more aggressive positions. I don't go into the bond market and hold IEF or TLT, for example, because I think that's going up. I'm simply holding the IEF because I don't want to be in the S&P, or I don't want to be short volatility. It's occupying a certain space in my portfolio, but it's not an active targeted position, if that makes some sense. So I don't really worry about what the bond market is doing. It's just right now I don't really hold any bonds because interest rates are expected to continue upwards. Once the Fed signals that they're going to start cutting rates again, which maybe by later this year or certainly into next year, I don't think they'll make it that far, then I might start adding those bond parking positions into my portfolio. But again, it's not a direct investment in bonds. It's just irrelevant to me. Okay, so I think the good news is I did an hour-and-a-half live stream fairly critical of Bitcoin, and seemingly don't have any haters. So I tried to do it respectfully, and hopefully people appreciate it. And if you got through those 5 myths and you still find reasons that crypto is good, then great. You're like me. There's other reasons beyond those. Just all I wanted was that these giants in the industry, the Michael Saylors and the Max Kaisers of the industry that just say, I'm sorry, guys, if you ever do catch wind of some random nobody that did a live stream and kind of did a backhand insult of you, I'm sorry, Max and Michael, but you guys say the dumbest things on Twitter that just make no sense. And you don't want people investing in things for the wrong reasons. So hopefully you can see through that nonsense. Basically, the bottom line, if you're following somebody in the investment world and their outlook and their mannerisms and their pumping of the product doesn't change no matter what happens to that product, no matter what new information comes in, then what's the point of listening to any of it, right? If somebody's just going to be a Bitcoin laser eyes to the moon no matter what all the time, then nothing they say is relevant. Absolutely nothing they say is useful for you. What you need to do is seek out people who are actually data dependent and can actually analyze things and say, okay, now's a good time to do something that here we've got some headwinds that we need to acknowledge, and this is not good, and that was a serious hit, and they need to actually take that stance. You have to have falsifiable opinions. If nothing is falsifiable, then it's God, right? I mean, it's just all the same. It's the same story over and over again. You go on Twitter, and today it's down 70%. Literally today, Michael Saylor. No, it wasn't Michael Saylor. It was that other guy, Pomp. Again, sorry to Pomp. I mean, obviously he would never watch my tiny little live stream, but just says the silliest stuff. He was talking about how, markets crash and all this stuff, but Bitcoin is unfazed. Unfazed other than the fact that it's down 71%? Do you mean other than that it's unfazed? What are you even talking about? I don't understand these people. So I was just encouraging people to kind of think outside the box, think for yourself. When people say these constantly reoccurring themes, that doesn't mean they're true. Just because a lot of people repeat something doesn't mean it's true. And there are a lot of myths in the Bitcoin world that those are not good reasons to invest. But not hopefully, but maybe you can find other good reasons to invest, like I did as a Bitcoin holder myself. So thanks, everybody, for understanding and listening and asking such great questions. I'll think of some other topic next week, probably trading, volatility.